So we're going to take a look at why the price of oil increasing might be scuppering central banks' monetary policy aims for the future. And then we're going to talk about something called short and long duration. I mean, probably only 1% of people understand what that means within this context. But we're going to take a look at why it's important. And then the trade in takeout today is going to be technical focused. We're going to look at why we need to trade areas over trading trend lines. To get the most out of what these videos are trying to tell you about, you have to be here every single day. So click subscribe to be able to receive them every day so that you can trade your edge successfully. So it's been an interesting few months for the oil market because the Saudis have cut production, Russia's cut production, and I guess OPEC in general have cut production. And this is having sort of a resultant effect on interest rates. Because what's occurring is, obviously oil is the most used commodity in global production, manufacturing, travel even. And so this is causing an upward pressure to the upside on prices. We spoke about it with Canada earlier last week in terms of, the CAD, so Canadian dollar, will be able to push higher in prices because Canada, is a producer of oil, and domestically that's going to cause an increase in prices, and we did see the resultant increase in Canadian CPI. However, for equities, it is a much broader problem. It's a way broader problem because, and we're going to explain a little bit about this in the second part as well, because the higher for longer narrative gets more and more embedded the longer that commodity prices stay up here. I mean, the last couple of days we have seen, a little trickle down from just above the $92 level on WTI. We've seen it trickle down now to 88.72, but that's got nothing on the increase from July. And it takes a while for these prices to feed through into, the economy, into demand, etc. And the big problem that I see here as well is the oil futures curve is in something called backwardation. So that means that the current price is higher than the future prices. Now, when you expect a strengthened demand in the future, you'd expect the futures curve to slope upwards like that, when really what's occurring right now is it's sloping downwards, which kind of means that people in the future aren't expected to demand oil as much, which makes sense considering the current data coming out. For example, just now we had Singapore industrial production data, and it's down 12% year on year versus about 3% expected. And this is, a worldwide phenomenon at the moment. Industrial production is getting absolutely smashed. So we're seeing the feed-through effects of the higher oil prices, but not onto a strong consumer, which is then reinforcing the higher for longer narrative. And if we base this kind of context on what Powell said last week with regards to a soft landing isn't our base case, then we're kind of seeing that he could be right, and it could be very much energy dependent. Now, what OPEC has said just yesterday, I believe, I say OPEC, one of the Saudi oil ministers, he said that if they start to see demand coming back into the market, then they'll happily increase production again. But right now, what they're doing is they're pinning the price as high as possible because they just don't see the demand coming in. Obviously, if you have lower price and heightened demand, then you're going to see the same revenues coming in. But if you have lower demand and a higher price, it's tough, especially when the variables are exogenous, when they're sort of outside of your price control, if you like. For example, US consumers domestically might not necessarily be being hit by the oil price being higher, but it's just confounding. So that's probably where he's coming from there. But with regards to the oil price, we should start seeing, I don't necessarily believe that we're going to tick up here, but there's a big problem if we do, 100% for the central banking narrative. And if we apply just a 200 daily moving average here, let me just set this up very quickly, we can see that the technicals are actually very supportive of a move higher. You can see here that we used the 75 level sort of as a support. You can say that comes down. I believe there's also one on the weekly as well. Yeah. So you can see there's a big support on the weekly too, the 200 weekly moving average, which is even scarier because this might inspire a move all the way up to $115. Now, JP Morgan yesterday actually came out, analysts at JP Morgan, and they said that they could foresee a move to $150, which would be pretty terrifying because it would mean that so many data points are aligned with, this is not the right chart, I need to adjust that. So many data points are aligned with 2007, 2008 in terms of where bond yields sit, for example, in terms of where equities are sitting still at relatively large price to earnings ratios. So, you know, it's a bit of a terrifying time, to be honest with you, because if they do reinforce that narrative of higher for longer through higher energy prices, well, you know, the consumer is pretty much stuffed. So I just want to talk to you about long duration and short duration. In front of me, I have the US 30-year Treasury yield. And this is a perfect example of long duration because what you're seeing here is something that has a very long maturity, 30 years. And you're seeing the subsequent increase in yields when people start selling it. Equally, you can have a long duration stock. And I'm going to give you an example of maybe a long duration index, actually, which is made up of long duration stocks. And that is the NASDAQ. Okay. The reason why the NASDAQ is classed as long duration is because you've kind of got a lot of growth firms in there. You've got a lot of firms that realize their revenue in maybe 10, 15, sometimes even 20 years. And so when you see yields tickle higher, you tend to see the NASDAQ fall off at a faster and more volatile pace than the S&P 500. The perfect example of this might be Tesla versus Ford. So Tesla's becoming less and less of a long duration stock because of how many cars they're getting out there now. But Ford is definitely an example of a short duration stock. You know, there's certainty with regards to what its revenues are, what the business model is. You know, it's a very, very old company relative to many others. Tesla, on the other hand, is quite a new company, quite revolutionary. I think it makes a profit just now. I'd have to double check that. But you know, you're more certain with what you're getting with Ford than you are with Tesla. That doesn't mean that there's any kind of benefit to Ford's price. That the market doesn't work just on, okay, well, we know that that's what we're getting, and that's pretty clear from the price of Ford versus the price of Tesla and the performance over the last couple of years. But this is a perfect example of, okay, so the context now is that the long end of the Treasury curve is selling off. This is affecting long duration stocks more than short duration stocks. Okay, so this is why the NASDAQ, for example, sold off by 3.29% last week, and the S&P 500 sold off just by 3%. There's a big differential there of, I think, 26 basis points. And it's more because of the influence there of longer duration stocks within the NASDAQ. There's a bigger concentration of them. So it's key to keep this in your mind when we're talking about the Treasury curve and the relationship between the Treasury curve and different types of stocks. You know, there's different sector rotations. There's different ways in which different stocks respond to how the broader Treasury market is behaving. Something that I think is absolutely key when trading is to really focus less so on being absolutely precise. Many people like to focus on a single number that they have to buy or sell a market off of. And I just don't think that really is the best way to do things. For example, I've got lines here, but really what I'm looking at is a box. I've got a box in my head. It's just faster to draw a line. So where I am considering support and resistance, for instance, is really, you know, this is a resistance level, or this is a resistance level. Then there's certain nuances that go into, how price is behaving there. For example, underneath a level like this, underneath a specific price, then I'd consider, okay, we're probably gonna do some buying there because, it's reached under a key low. There's probably some stops there. And there's probably some people that wouldn't mind just having a punt on some mean reversion. So there's different contexts that you can apply to it, but really the psychological effect of focusing on a specific level is far too damaging for me anyway, to be able to conduct any kind of good trading and execution. So alongside that, you can use areas as places to maybe even, cut up your position size. So if you've got a area of, say, 30 ticks, you could cut it into thirds. Every 10 ticks within that area, you have a third of your position on. And what this allows you to do is it allows you to be comfortable with allowing price to move around as well. It allows you to be comfortable with some volatility because you're saying to yourself, I think that the market's going to move around here, but I don't know whether it's going to be a specific price. What I'm doing then is I'm allowing myself to enter a tiny bit early, a tiny bit more towards where I want to, but then another tiny bit where I don't want it to. And there's kind of the old adage as well of, okay, trade where you actually put your stop, because most people get stopped out. Correct. You probably do as well if you're just a retail trader or learning. And it's because their stop loss is in the wrong place and they should probably be entering where their stop loss is. So bear in mind to trade around an area, and bear in mind that you can and you're fully allowed to add in orders, in multiple different position sizes. You don't just have to go full steam ahead with a single position.